Hello, everyone, and welcome. I'm excited to have you here today. We're about to dive into a topic that can truly transform your financial future. Today's presentation is titled, How to Start Investing in Stocks, Step-by-Step Guide. We'll walk through the basics of getting started, understanding the market, and building your confidence as an investor. Over the next few slides, I'll share practical tips and strategies to help you navigate the world of stocks with ease. So let's get started. Now, let's talk about what stocks actually are. Essentially, stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, which makes you a shareholder. This is a way for individuals like us to participate in a company's success. Companies issue stocks primarily to raise capital, which they use to fund growth, develop new products, or expand their operations. These stocks are bought and sold on stock exchanges, such as the New York Stock Exchange or NASDAQ. Understanding stocks is fundamental because they are the core of investing and help us see how the financial markets connect with real businesses. So, by owning stocks, we're not just investing in numbers, we're investing in the companies that drive our economy forward. Now, let's talk about why investing in stocks can be a smart move. One of the biggest advantages is the potential for high returns. For example, the S&P 500 has historically averaged around 10% annually, which is quite attractive compared to other investment options. When you buy stocks, you're essentially owning a piece of a growing company, and as that company expands and becomes more profitable, your investment can increase in value. Another benefit to consider is dividends. Some stocks pay out regular income in the form of dividends, which can provide you with a steady cash flow, especially helpful during retirement or for supplementing your income. Of course, it's important to acknowledge that risks do exist when investing in stocks. Market fluctuations, economic downturns, or company-specific issues can impact your investments negatively. But the good news is that with proper strategies, like diversification and setting realistic expectations, you can manage these risks effectively. Overall, investing in stocks offers a compelling opportunity for growth and income, especially if approached thoughtfully and with a clear understanding of both the potential rewards and risks. All right, let's start by talking about setting clear investment goals. This is really the foundation of a successful investment plan. First, you want to define your financial objectives, and that means deciding whether you're investing for something short-term, like a vacation or a new car, or for long-term goals such as retirement. Being specific here is crucial. Rather than just saying, I want to save money, try to set a concrete target like, I want to accumulate $500,000 by age 50. That kind of specificity helps guide your decisions along the way. Next, you need to determine your investment horizon, which is basically how long you'll be investing before you need to access those funds. Generally, the longer your horizon, the more risk you might be willing to take because you have more time to ride out market fluctuations. Conversely, if your goal is just a few years away, you'll want to be more conservative. And finally, it's important to make sure your goals align with your personal financial situation. Your income, expenses, and other financial obligations all play a role in shaping what's realistic and achievable. When your goals match your reality, you're more likely to stay committed and avoid unnecessary stress down the line. Remember, setting these clear, specific goals not only provides direction, but also helps measure your progress and keeps you motivated as you work towards your financial future. Now, let's talk about step 2, determining how much to invest. The first thing you want to do is review your income and expenses carefully. This helps you set a realistic budget, so you know exactly what you can afford to put toward investing without jeopardizing your financial stability. Next, it's crucial to establish an emergency fund, ideally covering 3 to 6 months' worth of expenses. This acts as a safety net, giving you peace of mind and protecting you from unexpected expenses or income disruptions before you start investing heavily. Another important point is to pay off high-interest debts first. These debts, like credit card balances, can quickly erode your financial progress because of the high interest rates. Clearing these out allows your investments to grow more effectively over time. And when you're just starting out, start small. Even a modest amount like $25 a week can make a difference over time. Remember, only invest what you can comfortably afford to lose, because investments always come with some level of risk. All of these steps tie back to the bigger picture, building a solid financial foundation before diving into investments. By doing this, you're setting yourself up for long-term success and making smarter, more confident decisions along the way. Now, moving on to step 3, determining your risk tolerance and style. This is a crucial step because it helps shape your investment approach based on how comfortable you are with market ups and downs. Think of it as understanding how much volatility you're willing to accept in your portfolio. If you're someone who prefers a more stable experience, you might lean toward lower-risk investments like dividend-paying stocks or bonds. These tend to be less volatile and provide steady income. On the other hand, if you're comfortable with more fluctuations and are aiming for higher growth, moderate-risk options such as mid-cap or large-cap stocks, index funds, or ETFs could be appropriate. They offer a good balance between risk and reward. And for those who are more risk-tolerant and seeking aggressive growth, small-cap stocks and growth stocks are options. These can be more volatile but also have the potential for higher returns. Another key decision is whether you want to manage your investments yourself or seek professional guidance. You might choose a do-it-yourself approach, either active, where you pick and manage individual investments, or passive, like investing in index funds that track the market. Or you might prefer to work with a financial advisor who can help tailor your strategy to your specific goals and risk profile. Overall, understanding your risk tolerance and choosing the right style is essential because it directly impacts your investment success and peace of mind. It's about aligning your investments with your comfort level and long-term objectives. Now let's move on to step 4, choosing the right investment account. When you're selecting an account, it's important to understand the different types available. For instance, a brokerage account is taxable and offers flexibility for investing in a wide range of assets. Then there are retirement accounts like 401(k)s and IRAs, which offer tax advantages for long-term savings. If you're saving for education expenses, 529 plans are a popular choice because of their tax benefits and specific use for education costs. Next, you want to evaluate the fees involved. This includes commissions, which are what you pay per trade, as well as maintenance fees or inactivity fees. Many brokers today actually have no minimum investment requirement, so don't be discouraged if you're just starting out. It's also crucial to look for research tools and good customer service. These features can help you make informed decisions and get support when you need it. And finally, consider the different types of brokers. Full-service brokers who offer personalized advice, discount brokers with lower costs but fewer services, and robo-advisors that use algorithms to manage your investments automatically. All these factors are key to selecting an account that aligns with your goals, budget, and comfort level, and ultimately ties into building a solid foundation for your investment journey. All right, now that you've chosen your stock, it's time to fund your account so you can start investing. The good news is, opening an account usually takes about 15 minutes, just some basic personal information and you're set. Once your account is open, you'll need to fund it, and there are a few options here. You can do a bank transfer, send a check, or even do an ACATS transfer if you're moving assets from another broker. It's also a good idea to set up automatic contributions. This way, you can practice dollar-cost averaging, which helps mitigate the impact of market volatility over time. Just make sure that your funds are available in your linked bank account before you start trading. That way, there won't be any delays or issues when you're ready to buy. Fundamentally, this step is about making sure your account is ready to go so you can smoothly move into the next phase of your investment journey. Now that we've laid the groundwork, it's time to pick our stocks. I recommend starting with stable options, things like blue-chip stocks, dividend-paying stocks, or ETFs. These are generally less risky and tend to offer more predictable returns, which is especially helpful for beginners. For example, investing in an S&P 500 ETF is a great way to get broad market exposure and diversify your investment across many large, reputable companies. This helps reduce risk compared to picking individual stocks. It's really important to avoid risky gambles or trying to chase quick gains. Remember, investing is a long-term game, and focusing on steady growth will serve you much better over time. And for those just starting out, index funds and ETFs are particularly beginner-friendly. They simplify the process because they track a whole index, so you don't have to pick individual winners. Overall, choose stable, diversified options that align with a long-term mindset, and you'll be setting a strong foundation for your investment journey. Now, moving on to step 7, learn, monitor, and review. This part is all about staying engaged and informed as an investor. First, it's really important to keep up with financial news. By doing so, you'll stay aware of market trends, economic changes, and any events that could impact your investments. This helps you make smarter decisions over time. Next, practicing with stock simulators, like the Investopedia simulator, is a great way to build confidence without risking real money. It allows you to test strategies and learn how the market works in a risk-free environment. Monitoring your portfolio regularly is essential, but it's equally important not to overtrade or react to every little market fluctuation. Instead, set a routine for review, maybe monthly or quarterly, and stick to it. Finally, as you review, be ready to adjust your investments based on your goals and how much risk you're comfortable with. The market and your personal circumstances change, so flexibility is key to staying on track. All of these steps help you stay proactive and aligned with your overall financial plan, ensuring that your investments evolve with you and the market. Now, let's talk about understanding risk and diversification. Risk, at its core, is the potential for losing some or all of your investment value. It's something we all face when investing, but the key is managing that risk effectively. That's where diversification comes in. Diversification means spreading your investments across different types of assets, like stocks, bonds, and even other options. The idea is that by not putting all your eggs in one basket, you can reduce the overall risk of your portfolio. For example, instead of investing everything in one stock or one sector, you might have a mix, some stocks, some bonds, maybe other assets. This way, if one area underperforms, the others can help offset that loss. It's really important to avoid putting all your money into just one stock or sector, because that concentrates your risk. Diversification helps you build a more resilient portfolio, which aligns with our overall goal of achieving steady, long-term growth while managing potential setbacks. So, as we wrap up, I want to emphasize that building long-term wealth is absolutely achievable, and stocks are a powerful tool to help us get there. The key is to start early, because the sooner you begin investing, the more time your money has to grow through compounding. Staying consistent with your investments is just as important. It helps you ride out market fluctuations and build steady growth over time. Educating yourself along the way is crucial, as understanding the basics and staying informed will empower you to make better decisions. And remember, it's always wise to seek advice when you're unsure. Professional guidance can help you manage risks effectively, because while investing does come with risks, they can be mitigated with proper strategies. And to leave you with a thought, there's a Chinese proverb that says, "The best time to plant a tree was 20 years ago. The second best time is now." It really captures the essence of taking action today, no matter where you stand. The foundation for your future wealth starts today, so the best time to begin is right now. If you found this video helpful, I really encourage you to like, comment, and share it with your family and friends. By doing so, you're helping support them on their own journey, whether it's learning new skills or gaining confidence. Remember, spreading these insights can make a real difference in someone's life. And don't forget to subscribe to our channel, Step by Step 2030, for more detailed guides that are designed to inform, empower, and show you how to care for your loved ones. Following us means you'll stay up to date with practical tips and strategies to navigate challenges effectively. You can find us on YouTube at Step by Step 2030 or on Instagram at Step by Step 2030. Your support helps us continue creating valuable content, so thank you for being part of this community.